The stock market hit another all-time high yesterday. Everything's great, right? The financial media is doing victory laps. Soft landing achieved. Bull market continues. America's economic engine is unstoppable. Meanwhile, companies are laying off workers at the fastest pace since the financial crisis. Job creation has basically stalled when we need to create jobs just to keep up with population growth. And the people running the biggest companies, the CEOs and executives who supposedly know these businesses better than anyone, they're selling their stock at massive ratios, but sure, everything's fine. Hey, welcome back to The Recessionist. I'm Tom, and I think we need to talk about what's actually happening here because if you've been following this channel, you know we've been ahead of the curve on pretty much everything that matters. We called Bitcoin's massive crash back in December before it happened, not because we got lucky, but because the math was screaming that institutional money was rotating out of risk assets. We flagged the jobs overcount months before the Bureau of Labor Statistics finally admitted they were off by hundreds of thousands of jobs. That's not a rounding error. That's a systematic problem with how they collect data. And our defensive positioning, the boring, supposedly underperforming allocation we've been running, it's quietly outperformed the market while taking way less risk, less volatility, better sleep, actual returns. So when I tell you the math doesn't add up on this market rally, I'm not guessing. I'm not doom posting for clicks. I'm reading the data that Wall Street doesn't want you to see. The recession model just hit 67 out of 100. That's pre-recession territory. Up sharply this month alone as multiple indicators started flashing yellow simultaneously. Labor market deterioration, credit tightening, consumer spending slowdown, they're all feeding into the same picture. And here's what's driving it in real time. The labor market is falling apart in slow motion. Companies aren't just cutting jobs, they're cutting hours, freezing hiring, eliminating contractor positions, the stuff that doesn't show up in the headline unemployment number until months later. We're at what economists call stall speed. That's the technical term for when job creation can't keep up with the number of people entering the workforce. It's like being in a plane that's not quite crashing, but definitely not climbing. Unemployment has ticked up meaningfully over the past 6 months. That sounds small, but historically, once unemployment starts rising, it doesn't just plateau, it accelerates. People are pulling back on spending. Retail sales growth has slowed to basically nothing when you adjust for inflation. Credit card balances are at record highs while savings rates are at record lows. That's the definition of a consumer that's tapped out. Oil is creeping higher too, when the Fed's models assume much lower prices. Every dollar increase in oil prices feeds directly into inflation expectations, which makes the Fed's job harder. But the stock market is partying like none of this matters. And that disconnect, that's not normal market behavior. That's what happens when prices are divorced from reality, when the game is rigged. So let me break down what's actually happening here. The stock market isn't the economy anymore. It stopped being the economy sometime around 2010, and it's become something else entirely. It's a wealth transfer mechanism from retail investors to institutions. A rigged casino where the house always wins and the house isn't even pretending otherwise. Here's the math that nobody talks about on CNBC. Corporate stock buybacks hit over $1 trillion last year. That's companies literally buying their own shares to pump the price up. Not because business is good, not because they have great investment opportunities, because it makes their stock options more valuable and it boosts earnings per share without actually growing the business. It's financial engineering, not economic growth. Apple alone spent tens of billions on buybacks last year. For context, that's more than the entire GDP of most countries. They borrowed money at low interest rates to buy their own stock at high prices. Think about how insane that is. Meanwhile, insider selling is at the highest level in over a decade. CEOs, CFOs, board members, they're dumping stock at massive ratios versus buying. Jeff Bezos sold billions worth of Amazon shares recently. Elon Musk has sold over $20 billion in Tesla stock in recent months. These aren't small diversification trades. These are massive coordinated exits by the people who supposedly know these companies better than anyone. Think about that psychology for a second. The people who have access to internal data, who know the competitive landscape, who understand the real financial position of these businesses, they're selling at the exact moment retail investors are being told to buy the dip. Warren Buffett's Berkshire Hathaway is sitting on hundreds of billions in cash. The greatest investor of all time can't find anything worth buying at current prices, but your financial advisor is telling you to dollar cost average into index funds. And here's where it gets really ugly, where the systemic risk becomes clear. Most of your money isn't even picking stocks anymore. It's going into index funds. Passive investing sounds safe, right? Diversified exposure to the entire market. Set it and forget it wrong. Because when everyone buys the same basket of stocks through index funds, it creates artificial demand that has nothing to do with the underlying businesses. The top 10 stocks in the S&P 500 now make up over 30% of the entire index. Apple, Microsoft, Nvidia, Amazon, Google, Tesla, Meta, these companies represent almost a third of what you think is a diversified investment. So when you buy a diversified S&P fund, you're actually making a concentrated bet on just a handful of companies. And here's the kicker. Every time someone buys an index fund, that money gets mechanically allocated to these same companies based on their market cap, not their fundamentals. Nvidia's market cap went from hundreds of billions to over $2 trillion in just months. Not because their business grew proportionally, because index funds had no choice but to keep buying more Nvidia as its weight in the index increased. It's a feedback loop that completely disconnects prices from reality. More money flows into index funds, which pushes up the prices of the biggest stocks, which makes those stocks a bigger portion of the index, which means even more money goes into them. And when that feedback loop breaks, and it always breaks eventually, the crash is violent, because all that mechanical buying on the way up becomes mechanical selling on the way down. We saw a preview of this when index funds had to sell tech stocks regardless of fundamentals just to rebalance. Passive investing creates massive distortions that active investors then have to navigate around. It's like having a drunk driver in the other lane. You can be the most careful driver in the world, but you're still at risk when they finally crash. So here's how this plays out over the next year to year and a half. There are really 3 paths from here, and I want to walk through each one because this affects every financial decision you make. Path 1 is the soft landing. The Fed somehow navigates this perfectly. They cut rates just enough to support the economy without inflating more bubbles. Inflation comes down to their target without killing growth. Job losses stay contained. Corporate earnings hold up better than expected. The market multiple compresses gradually as reality slowly catches up to prices. You lose maybe 15% in a boring, slow grind lower. Nothing dramatic, nothing that makes headlines, just a slow deflation of the bubble. The model gives this about a quarter probability. Right now, it's possible, but it requires everything to go right simultaneously. Path 2 is the hard landing. Something breaks. Could be commercial real estate. There's over $1 trillion in commercial real estate loans that need to be refinanced soon, and most of them are underwater at current interest rates. Could be an oil shock if geopolitical tensions escalate. Could be a credit event that nobody saw coming. Maybe one of these overleveraged private equity firms that binged on cheap money finally hits a liquidity wall. The model's forecast is showing this as the most likely scenario right now, about half probability. Markets drop significantly in months. Unemployment spikes. The Fed has to choose between fighting inflation and preventing a depression. This is your standard recession playbook, just with higher starting valuations. Path 3 is the nightmare scenario, and I really hope I'm wrong about this. The everything bubble pops all at once. Stocks, bonds, real estate, crypto, the whole financial system that's been built on cheap money just unravels. This happens when you get a cascading liquidation event. Leveraged funds start selling everything to meet margin calls. Index funds get massive redemptions and have to sell regardless of price. International investors pull capital back to their home countries. Credit markets freeze up completely. That's the financial crisis all over again, but potentially worse because the starting debt levels are so much higher. The model puts this at about a quarter probability, lower than the hard landing, but way too high for comfort. And here's the part that really keeps me up at night. The Federal Reserve is completely trapped. They've been cutting rates because they're worried about the economy slowing down, unemployment rising, consumer spending weakening, business investment declining, all legitimate concerns. But every time they cut rates, asset bubbles get bigger, stock prices go higher, the disconnect between financial markets and the real economy gets worse. They're trying to stimulate the economy, but most of the stimulus just inflates asset prices that only benefit people who already own assets. They can't keep cutting without creating bigger bubbles, but they can't stop cutting without potentially crashing the economy. It's the definition of a policy error trap, and we've seen this exact movie before. In 2000, Alan Greenspan was cutting rates while the NASDAQ was hitting all-time highs. Everyone said it was a new paradigm. The internet was going to change everything. Traditional valuation metrics didn't apply anymore. Sound familiar? The Fed kept cutting to support the economy, but all it did was keep the bubble inflated until it finally popped and the NASDAQ fell catastrophically. In 2007, Ben Bernanke was cutting rates while housing was in a massive bubble. Subprime mortgages, no-doc loans, people buying houses with no money down that they couldn't afford. The Fed said the housing market was just experiencing some froth in certain regions. They kept cutting to prevent a recession, but all they did was make the eventual crash worse. Both times, the Fed was behind the curve. Both times, retail investors, regular people trying to build wealth for retirement, got absolutely crushed while the institutions that created the mess got bailed out. I'm not saying Jerome Powell is incompetent. I'm saying he's in an impossible situation with no good options. And that's when policy mistakes happen. So what does this mean for your actual money? If you're sitting in index funds thinking you're diversified, you're not. You're making a concentrated bet on the same handful of companies that insiders are aggressively selling. You're paying management fees to buy overvalued stocks that smart money is rotating out of. If you're buying individual stocks because your favorite YouTuber or TikTok influencer said they're cheap, you're competing against algorithms that can process news and earnings data in milliseconds, high-frequency trading firms with billions in capital, and institutional investors with teams of analysts and inside connections. The game isn't fair. It was never designed to be fair. If you're counting on your retirement account to fund your retirement, you're essentially betting that this bubble can keep inflating for the next several decades. That's possible, especially if the Fed keeps printing money to prevent any serious correction. But it's not probable given the math we're looking at. And if you're thinking about buying the dip because stocks always go up in the long run, that's potentially the most expensive lesson you can learn the hard way. Japan's stock market peaked decades ago and still hasn't gotten back to that level. That's generations of temporary decline. Stocks don't always go up, especially when they start from historically extreme valuations. Look, I get it. This stuff is incredibly frustrating. You work hard, you save money, you try to do the right thing by investing for the future and building wealth responsibly. And then you find out the system is rigged against you from day one. That's not your fault. You didn't create this bubble. You didn't ask for a financial system where asset prices are divorced from reality, but pretending it's not happening isn't going to protect your money when reality finally reasserts itself. The model sits at 67 out of 100 pre-recession phase, rising fast. I remain defensively positioned, and I'm not changing course until the data changes. Heavy cash allocation earning solid returns in money market funds and short-term treasuries, reduced equity exposure in carefully selected defensive stocks with strong balance sheets, and recession-resistant businesses. Some precious metals as an inflation hedge and currency debasement play, some energy exposure because oil tends to hold up better in the early stages of economic decline. Same positioning I've held, and it's outperformed with way less volatility and stress. If you want to track this stuff in real time without having to build your own models, I put together a full dashboard, economic indicators, recession forecast, sector analysis, the works, affordable monthly subscription, cancel anytime. No, long-term commitments. Here's specifically what I'm watching over the next month. If the model breaks above 70, that's confirmation we're moving from pre-recession into actual recession territory. Historically, once we hit that level, recession onset follows within months. And if insider selling stays elevated, that's institutional capitulation. The smart money isn't just taking profits. They're heading for the exits entirely. The question becomes whether retail investors figure this out before or after they lose their shirts. Third thing to watch, corporate earnings guidance for the next quarterly cycle. The market can ignore bad economic data for a while by saying it's backward-looking. It can't ignore companies missing their own forward projections. If we get another round of widespread downward revisions, the narrative shifts from soft landing achieved to earnings recession incoming very quickly.